Hey everyone, Mortgage Nerd here. Coronavirus, mannequins, and interest rates. What do they have to do with each other? Well, I guess if you're afraid of the coronavirus, the best cure is to just cut off your head like this mannequin. That's what that has to do with a mannequin. I don't know, I just want to have fun with it. But really, coronavirus and interest rates. Go back to one of my videos. Actually, here, look at what I said weeks ago. So geopolitically, the only thing that's really going on is the coronavirus. And here in the US, the economy's strong, but it's not pushing rates higher. So we're in a good place. Long term for this year, we should be in a good place for rates. So why weren't people listening to me back then? I locked people in a couple months ago with really low rates. Guess what? Rates are at their lowest in history. I refinanced myself. I closed in mid-February. Does it mean that, okay, maybe I would have gotten a little bit of a better rate? Yeah, but look, a bird in the hand is better than two in the bush. So take advantage. You don't know what's going to happen tomorrow. You don't know what vaccine is all of a sudden going to appear and now we have a cure and everyone's fine. Because once that happens, I guarantee you we're going to see a bounce. So what happens when a ball bounces, boom, it hits its lowest point and it goes up quickly. I can show you in history, Brexit, it happened. It hit the lowest point in history, interest rates, and then bounced up like that. So let's look at the charts and see what's going on. Coronavirus hits the US right around here. Ha! Mortgage bonds skyrocket. Why? Stocks go down. People take their money from the stocks. They put it in the mortgage bonds. Put it right here in the mortgage bonds. And when they put it into the mortgage bonds start doing well. When the mortgage bonds start doing well, the mortgage rates go down. Forget about the Fed rate. The mortgage rates, the fixed rates go down when that happens. Now, U.S. Treasuries, the 10-year Treasury. Let's look what's happening there. The U.S. Treasuries are at their lowest in history. In history, ever. And the lower the Treasury, the lower your mortgage rate. Hello, people. If we can lower your rate by 1%, and it's a $400,000 mortgage, that's $4,000 a year that you're saving. That's like increasing your income by $4,000 a year. You'll say, oh, well, I have all these closing costs if I do that. But if your closing costs are $5,000, you save that money in a year and a few months. It's not a big deal. So look here. Right now, we're at the lowest point, all the way here on the bottom right. We've never been down to 1.03 on the 10-year Treasury. The lowest point before that was in 2016, 1.32. That's a huge difference, huge. Look at how fast it fell over here. Actually, let me give you a close-up. So here's our close-up. Look, I locked my rate in this range right in here because it was great. Rates were low. They're not that much lower now, but they're still great. Maybe they'll go down a little bit more. I don't know. But they'll definitely go up at some point. The question is when. So coronavirus is really affecting our economy. That's why the Fed is lowering the rate. That's why people are taking their money out of stocks and putting into safer bets like mortgages. And so when an economy doesn't do well, our mortgage rates go down, which helps stimulate the economy more. If you're saving $200 a month, that's $200 more you can go out and spend on masks or beheadings on yourself to avoid coronavirus. I don't know. Thank you so much for watching. I hope you enjoyed this. Try to make it fun for you. Mortgage Nerd out.